We were just talking ahead of time, and one of the things I wanted to ask you about is I've seen you driving around recently a brand new toy. And dude, it looks like the fastest car I've ever seen. You got a new Corvette, right?
We call it the Batmobile.
It looks like it.
Yeah.
It looks like it.
It's not brand new. It's a 2015. So
okay.
It's had one owner before, and I love cars. I'm a car guy, and I'm having the most amazing year in business, and so I just decided to sort of splurge. It was an impulse thing, but yeah, it's very fun. It's very loud. I apologize for that in advance.
Dude, I could hear it like when you pull out.
Yeah.
That's funny. You had the Mustang though a couple years ago, right? You ended up getting rid of that. So faster, slower, more fun, less fun?
The Mustang is like an entry-level sports car, and this is a real sports car.
What is it? Is it like because I know those have huge, like is it a V12 or something like that?
No, it's a supercharged V8 that puts out 650 horsepower.
Jeez, man.
Yeah.
That thing's got to be fun to drive. 2 seats?
Two-seater. It's fun to drive, but you also have to be careful with it because it's got so much power, and Corvettes have light rear ends. So if you hit the gas too hard, even at significant speeds, you could spin out. So
spin out, or just like fishtail spin out, or is it like
with the traction control will catch you, so you'll just sort of fish a little bit.
Yeah.
But if you were to have the traction control on, you could totally wipe out and spin out while even going 60 miles per hour down the road. So,
jeez,
I have to get used to it. I intend to go to a track to take some lessons to learn how to be a better driver. But it's just a fun toy.
That'd be cool. They do it over at Watkins Glen, don't they? Is that where you'd go?
That's a big track though. They have smaller tracks around, and a buddy of mine's gonna take me out to one. But yeah, it's the difference between men and boys is the price of their toys, right? So that's all it is. Big toy.
That's funny. So I wanted to ask about that because one of the things that is really interesting right now around just money, finance in general is I'm curious, a lot of people are so concerned about like getting ready for retirement. And then on the other hand, a lot of people just spend everything they make. And, this whole podcast that we want to talk about today, we want to talk about recession, inflation, and all the hot topics that are going on in just macro economics. But I'm curious to understand, like, as someone who isn't just flashy, right? It's not like you're walking around all the time in fancy clothes. You don't live in a mansion. Like, you like cars. That's awesome. So when you have extra money to spend, you might spend it on a fun car. Like, what should we really be thinking about in terms of our money mindset? I mean, should we spend what we have? Should we enjoy it in the time we have here in this world? It's such a small period of time. Or should we be really focused on the future?
The answer is yes. So in my line of work, I always tell people that the goal is not to die with the most amount of money possible. Money is a tool to help you accomplish happiness. And there's tension between the present and the future, and you have to learn how to responsibly balance that. So if you set your priorities and meet those savings objectives, then once you're done, then have some fun. Yeah, it's my attitude about it. So yeah, it's odd at work because sometimes I'm in the situation where I'm trying to encourage clients to spend money, and tell them to enjoy it, because if they don't, somebody's gonna. So it might as well be them. They earned it. So go have fun.
Yeah, I mean that's got to be hard for some people too, especially in the situation we're in right now. Like, are we technically in a recession? I mean, is that
so? Before we get into the finance stuff, my compliance department would want me to say that the things that we're going to talk about today are forward-looking, in my opinion, and that you should not act on any of the things that I say without talking to your own financial advisor. That being said, recessions are only ever diagnosed ex post facto. So you never know when one began until typically it's over. However, a technical recession is defined as 2 quarters of negative GDP growth. We did have a negative quarter in Q1, and Q2 numbers will come out in July. But the most up to date, projection is that's made public by the St. Louis Federal Reserve, it's the Atlanta Fed, and they have a thing called GDP Now. Anybody can go and Google GDP Now and see what the current expectation is for the current quarter's GDP growth in the U.S. And right now that's at 0.
So it could kind of go either way.
It's trending down. So if hypothetically, so this gets to the point of, are we in an academic recession, or are we in what feels like a recession for most people? And I would say my opinion is that we probably will be in a technical recession, but that we are certainly in economic decline. All leading indicators, coincident and forward-looking, are taking a nosedive. And so if we escape technical recession because Q2 GDP growth is, flat or slightly positive, does that mean much? The answer is no. It's a coincident or even lagging indicator. The forward-looking indicators are not good. So we are, even if we technically avoid a recession in Q2, we are probably going to be bouncing in and out of flat to negative GDP growth for some period of time. And when it's all done, people will look back and say, maybe it didn't technically meet the definition, but it was all a recessionary period that we are experiencing right now.
Yeah, well, in a way, I guess it's some of those metrics by the Atlanta Fed or whatever Fed puts out information. I mean, that can, I don't want to say be manipulated, but it varies on a lot of factors, right? So it's like, well, they may be able to say, okay, some of this information, well, it's the fact, I guess I'm trying to figure out exactly, like, can they manipulate those numbers just so it doesn't appear as though we are in a recession or not?
I'm not sure. I mean, those are the numbers that everybody goes by.
Okay, so they're pretty universal.
They're universal, and whether or not they're manipulated or somebody can adjust, a statistic to for political purposes or something like that, I don't know. But it's all the same numbers. We're all using the same numbers, and the CPI is calculated. The Consumer Price Index is calculated differently in 2022 than it was in 1980. So you could find a lot on the FinTwit or financial Twitter of people talking about how CPI is currently around 8.6, but if it was measured like it was, or the formula was the same as it was in 1980, it would be something like 14.
No way, really?
Yeah, but the world's a little different. I mean, they didn't have Amazon or that type of thing back in 1980. So it should probably change as the world changes.
Yeah, I actually heard something recently that said, and I know that we go off a bunch of different metrics in terms of the stock market, but I heard the Dow was down, was it 11 of the last 12, was it months or quarters? Not quarters.
It would have to be months.
Yeah, I think 11 of the last 12 months. Or you know what? It might have been weeks, and it was 11 of the last 12 weeks, and that hasn't happened since 1929.
It wasn't months. It was, right. So we have been in an orderly bear market.
Yeah.
Not a disorderly bear market, which we saw in March of 2020 during the COVID, where there was, panic selling, complete and total capitulation by institutional and retail investors. This has been a largely orderly, steady march down. But we have been in a bear market now for 6 months. But we have not had a washout type of sell-off, panic, all-out panic event yet.
Yeah, well, it's scary to think about. I mean, especially when you're thinking about something that is progressing slowly, because while you're in the midst of it, you're wondering how low is it going to go. Right? And it's, I was on a walk.
$1 million question.
I know.
You do that one, you could retire.
Well, I was on a walk with my wife yesterday, and we were talking, and I made the comparison to something that my grandfather and I talked about a long time ago, and back in, I think it was I don't think it was '08, but it was one of the market downturns at some point. He got nervous about his life savings,
Sure.
about his nest egg.
Yeah.
And he saw it kind of withering away. And I don't know how far down it was. Let's call it, 30, 40%.
Yeah.
And he pulled it all out of the stock market because
Yeah.
he wasn't sure about how low it was going
It's
to
gonna
go.
get worse. Yeah.
And ultimately,
can't take 2 hits like that, right?
exactly. And ultimately, it ended up recovering. And
Did he miss
lost.
it?
Yeah, he did. And he lost a lot of his nest egg because of this kind of like reactionary decision he made to pull his money out. So, we're in this time now. We see the stock market go down. I know when I'm looking at my portfolio within the stock market this fiscal year, it's down quite a bit. Call it 20-25%, I believe,
Yep.
from January to now. And it seems like if you're in a bunch of index funds, it's probably what you're looking at. But not to like go right into it, but you just said you're having your best year ever.
Yeah.
I mean, why are you having your best year ever? What are you doing differently than me, who's just
So
all
I'm
in
not-
S&P 500 indexes and whatnot?
Yeah. So I'm not an index investor. So I'm an active manager, and I'm actively trying to avoid pitfalls for clients. And I've had a great deal of success in this bear market, and for which I am grateful, and so are my clients. So your strategy of just ride through whatever market comes, own the market, low cost, and you'll be okay, has worked 100% of the time in the past. I have no reason to believe it won't work again, but you could experience some very long and drawn out and painful time periods. And I would argue that we are experiencing a calamity of large economic proportions that essentially amount to a regime change in the market era. So we've been in a declining inflation and declining interest rate environment really since 1980, and lots of things work well in a declining interest rate, declining inflation environment that don't work well in a rising interest rate and rising inflation environment. A lot of the strategies, a lot of the investment managers have grown up during that period and have never invested through a different regime. And so, for example, a risk parity strategy, or otherwise known as portfolio management or modern portfolio theory, where you have a certain more amount of your portfolio in stocks and you have a certain amount of your portfolio in bonds, and they have a negative correlation, and your bonds hold up when the stocks do poorly, and when the bonds are frustrating, it's typically the stocks are doing well. And that's broken. The 60/40 portfolio is having its worst year, I believe, ever.
And that was Vogel, right? Didn't he?
Volcker. Paul Volcker was the chairman of the Fed, appointed by Jimmy Carter, and he rose interest rates to ostensibly crush inflation back in the late 70s and early 80s.
Well, it's crazy to think about that correlation, because like when I look at my portfolio, I follow a similar ideology to that, right? Like it's stocks and bonds of some sort.
Yes.
And like while the stocks have gone down, so have the majority of the bonds. And like my concept of this is so elementary compared to yours.
No
but
place to hide, right?
It doesn't. Yeah, there's no place to hide.
So this is what the regime change is essentially, and I've made a call last year that would be a great call for anybody's career, which was that the inflation was going to get out of hand, and that was going to break the stock market, and it would be bullish for the things that had underperformed for a decade or more, and it would be terrible for the things that had led the market for the last since the previous recession, which was the great financial crisis. And so it's good to think of inflation as a magnet that pulls interest rates in its direction. So if inflation is high, it will pull interest rates up towards the rate of inflation naturally in an economy. And if inflation is low, it will pull interest rates down, down until it is essentially they essentially meet. And so the technology stocks, the growth stocks, where earnings are in the out years, need low inflation and therefore low interest rates to have their valuations make sense. So if you are, you're planning on a lot of earnings for your growth company that is 10 years out, well, you have to basically bring that back to a present value. And if inflation is very low, it pulls back very well. But if inflation is very high, it pulls back very poorly. And so the regime change was from growth leadership in the markets. So you saw, and this had a real bubble effect with COVID too, with the economic lockdowns, and things that did well were things like Amazon and Facebook and Zoom. These were all the growth stocks. It was a perfect storm to the benefit of these technology, communications, growthy type sectors. And that all is unwinding. We're in the process of seeing another 1999 NASDAQ bubble implode, and that inflation dynamic, which we can talk a lot about, is likely to persist, and it's likely to continue to have these effects which favor investments that have done well in prior inflationary periods, of which there are some. So, like the 1970s is a good example. The World War II and the post-war era for probably 5 to 10 years was another era. So, essentially, if you look at what did well during those time periods, it was real assets, things like oil, metals, industrial metals, farmland, gold, silver, all of those things did real well. And so, last year I rotated out entirely. I sold my last tech stock in December, and I've been essentially gold and commodities. And so I've had a wonderful year, and so there you go. That's how I've done it.
I think the fear is being imbalanced, right? I think for the average investor, and I'll call myself the average investor, is just like when I try to wrap my head around the idea of chasing growth sectors, areas, whatever you may call them. The fear is like you see something running high all the time. It's like, the tech is going crazy. And COVID was a great example of that, like you alluded to, just like all these tech stocks blew up.
Right.
Like, how high are they going to go? How high are they going to go?
Yeah.
And then to completely get out of there and get into commodities is scary. And then, like, I've invested in gold in the past, and I've watched it, and I have gold, but I look at it and I'm like, it's not like even that seems to be coming back. It almost seems like nothing is correlating to success, at least in my portfolio, right? And maybe it's just that, and correct me if I'm wrong, it doesn't have to have exponential growth. It just has to maintain its store of value.
Gold is flat this year, right? Which is losing to inflation, but it's crushing the stock market.
Yeah.
So the other problem is, and you're probably faced with this, most people's retirement plans through work, their 401ks, their 403bs, were designed to work well in a regime that, in my opinion, we're leaving. So, for example, at Sage Rutty, I requested that they add a commodities fund and a gold fund to our 401k lineup. And those funds will be available in the next 2 weeks or so. And, I will be availing myself of those funds, just for my compliance, their happiness. Again, this is not specific advice. You have to talk to your financial advisor, but that's what I'm doing.
Yeah. No, it's I'm curious to know because like I don't have a financial advisor, and it's something that it's because I got burned in the past. I had an advisor who, and burn's not the right term, I guess, but I have the tendency to be very trusting
Mm-hmm.
of people. I look at people who have put in the work in their career, like yourself, who've studied the market, they have a history. I trust advice.
Yeah.
And the advisor that I had in the past um, had been super bearish on the market. And we're talking back in like 2005, 2004, right?
Okay.
Super bearish. Thought that the fundamentals were terrible. Didn't want anything in the growth sector. Had a lot of shorts. He was actually like shorting a lot of tech stocks, and then he was super into gold. And it was years and years of my early career of just losing money.
Mm-hmm.
And you know, the thought still was there. Like, are the fundamentals right? Are they wrong? But ultimately, we ended up parting ways, and I decided to take care of it on my own. But I'm curious for someone that is looking for a financial advisor. Like, say you couldn't manage your own money, right? You had to give all your money to someone else. How would you look for a financial advisor? Like, what would you ask them? How would you determine which advisor to use?
Great question. And I have a workshop that I put on called Fire Your Broker, which is
Really?
essentially how to hire a financial professional. And I put that on through Sage Rutty University, which you can, if you go to sagerutty.com, you can find a video of that presentation. It's called Fire Your Broker, and it basically walks you through 10 criteria that you would want to use to evaluate your options. So you could, create a little, spreadsheet, and on the the rows you could have these 10 criteria, and on the columns you could have the different advisors
Yeah.
you're considering, and whoever checked the most boxes, you probably would be making a good choice. But it's not just financial professionals. I mean, we are not in a typical person like you or me is not in the business of hiring professional help all the time. We hire
Yeah.
legal professionals, we hire medical professionals, we hire financial professionals, and what the hell are we doing? I mean, we rely on some advice, we rely on some credentials, but how do you know you're doing a good job, or you're making an optimal choice? And so if you go to sageruttyuniversity.com, you'll find my presentation there, and watch it, and you can.
What are the top three criteria in your mind then?
The top three criteria would be somebody has to have be a full-time fiduciary. The other would be top three. Work on a fee-based level so that there's no commission conflict of interest. And the third would probably be credentials. The unfortunate part about our industry is that in order to be licensed to sell securities by the government, you don't even need a high school diploma.
What?
Last I looked, to pass the Series 7 or to apply to take the Series 7, you didn't need to even prove that you have a high school diploma.
Wow. So you just have, but you still have to study and understand, like,
Yeah, it's not
'cause
very.
the Series
it's not,
7
It's not real training though.
right?
But so if somebody has a CFP,
Yeah.
which stands for Certified Financial Planner, or a CFA, which stands for a Chartered Financial Analyst, those types of things, you do these days need a bachelor's degree and relevant experience, and to be able to pass rigorous qualifying exams and stay up through continuing education. So while the circumstances of the industry are such that you could just be a salesperson and pass this, the licensing exam, it's pretty easy for consumers to avoid that fate if they look a little deeper.
Yeah, it's interesting. You actually say that they should do a fee versus a commission. It's almost counterintuitive in a way. Like, I think about a lot of jobs when you're thinking like, oh, they're not in the best interest because they're earning commission on a certain product they're selling. But at the same time, like if in finance, my assumption was always, well, if I do better, then like you should do better as my financial advisor. And to me, my layman mind, all that meant was, okay, if Brennan is managing my portfolio and he grows at 20% this year, then he should get more than if he grows it 1%. But when I step back and think about it, and correct me if I'm wrong, you are making more, right? Because if you grow 20% and you're charging a fee of assets under management, you're still making more. It's just that you're not selling specific stocks, ETFs, mutual funds that you earn a higher commission, and it may not be better for my portfolio.
Correct. So the fee-based strategy is the most, in my opinion, the most elegant alignment of client and advisor interest, because if the client has more money, the advisor makes more money. If the client has less money, the advisor makes less money. That's not always practical for all financial tools. Insurance doesn't work that way. It can be better to buy individual bonds on commission than pay a fee on it. So, but generally that holds up. So I would say, commissions, you don't want to be worried that your financial advisor is calling you to sell this or buy that because they need a paycheck. Yeah. So if you take the fee-based strategy, that eliminates it. There's also another option, which is fee only. I don't want to spend too much time talking about it because not a lot of people do it. Essentially, if you're a do-it-yourself kind of person, a fee-only advisor could make sense. So that could make sense for you. Have some professional look at it, and they'll charge you. I don't know how much. Maybe $1,000 or $2,000 or something like that. And then just say, yeah, you're doing a good job, or do this a little differently, and then you go out and implement on your own rather than paying an ongoing fee.
Yeah, I'm curious about inflation because I don't want to get too political on this. However,
it's easy not to.
It's I know, right? Well, I mean, like you look at inflation and you wonder why it's happened, like what has caused it, and then
the reason why is bipartisan.
Okay, so okay, well, why? And we had this conversation maybe a year or two ago, and I don't recall exactly what came of it or what sparked it, but yeah. I have thought, and let's just explore this idea. I have said, and so Biden's president right now.
Yep.
Trump was a prior president.
Yep.
I've liked to think of myself as like a fiscal conservative.
Okay.
However, when the stimulus package hit during COVID, I understood that there was people really struggling financially. I took a big hit financially as well, but that stimulus package, that influx of money, when that was being released, my thought was this is going to destroy the economy and create massive inflation in the very near future, because you can't print trillions of dollars and expect the price of everything not to go up like
good
crazy.
Instincts. So yeah, the federal government over the past 2 years, maybe it's a little more than 2 years now because we're in June, but essentially over the past 2 years since COVID began, increased the amount of money in circulation by about 40%, which is
almost double.
No, 40%.
Okay.
So it's almost like
not 100. So
half again.
Half, yeah.
So if you think about it, and I've written about this in my newsletters, in the 245-year history of the United States, all of the money that was ever released into circulation was increased by 40%. Trillions of dollars. It's something like, I think it was like $8 trillion. And unless you have a commensurate increase in productivity, essentially what that means is that prices are going up by 40%. So the Econ 101 example that works really well to explain this is, say you have an economy whose productive assets are represented by 10 apples, and you have all of the money in the economy represented by $10. For simplicity's sake, it's pretty easy to say you can exchange each apple for $1. Let's say the monetary authorities come and they say, boom, now there's $20 in the economy, but you still only have 10 apples. So now you can exchange each apple for $2. So the price in nominal terms of the apple just doubled. So essentially what they did was increase the amount of money in circulation without a commensurate increase in the economy's productivity will lead with long and variable lags to a inflationary regime. But that is not the only reason that we are experiencing inflation, but it is a major and predictable outcome of it. So I think that if they were to do it over, maybe they wouldn't do the PPP as generously, or maybe they would cut benefits off. And there's it's time to pay the piper, and there's no avoiding it now.
Yeah, I mean, who gets hit the worst in inflation? Because this is what scares me, and this is what it's funny because bipartisan, unipartisan, whatever it may be, I always feel like, and maybe it's this trusting part of me, like we'll go back to that I trust people. I've always somewhat believed that politicians on both sides at every level, I generally believe they're trying to do their best for their constituents. I generally believe that.
So I'm more cynical than you.
I know that. I think that in a lot of ways they believe that what they are doing should have a positive impact in some way. Now we can argue the merits of that, but I look at like this idea of providing these PPP loans and these stimulus checks. And I think the idea was good. It was, okay, let's give people money to float their bills for a couple months so that they could get by, because we don't want people really struggling. And I think that's a really fair and important thing to consider. However, understanding the impact of inflation on specifically the lower and lower middle class needed to be considered, and I worry that this is going to be that much harder for specifically the low and middle class, because I want to go back to portfolios, right? Like if you have a really well-balanced portfolio and you're not just in the market, you're not just in stocks and bonds, but you may be invested in real estate, you may be invested in other areas, Bitcoin. I know you took a bath there too, but if you own assets in an inflationary period, you're much better off. Well, who doesn't own assets? Like the poor and lower middle class. So am I right or wrong when I assume inflation more so impacts the lower middle class than any other group of people?
You are absolutely correct. And there will be a political comeuppance, most likely, because of that we haven't foreseen. And I grew up like that. So, not, wearing hand-me-down clothes or having to use last year's school books or notebooks for the next year. Or the number, to bring it up to a higher level, the number of people who are partially filling their gas tanks has gone to the moon recently, because or the people who are shopping for the lowest price gas station. I was just reading about this last week. Is they're going up and up. There's a website called Gas Buddy that tracks this stuff. So the people who and got myself into a position where I don't have to worry about affording groceries for the week. If they are $25 more expensive this week than they were last week, we're not going to not buy the food. But there are people out there, a lot of them, who are not going to buy the food. And so while coming back to your argument about how it makes sense that you would want to help people in a situation through a crisis like the COVID crisis, I don't think anybody was against it at the time. There were a few people who said this could be real bad down the road, and they tried it, and so now it's time to pay the piper. And I don't know that there's the way. I don't think there's a way around it, but the Federal Reserve is certainly going to try, and this is where things get real interesting. So I don't know if you want to go there or not, but
I understand. So the Federal Reserve, they pretty much dictate interest rates, right?
Price of money, yes.
Yeah.
Yep.
So they've talked about trying to beat inflation. right? I mean, is that
They
what
are
you're
trying
alluding
to
to?
cause, they wouldn't say this, again, it's my opinion, they are trying to cause a recession and a bear market to reduce inflation. So that would hurt. It's kind of, that would hurt the poor people ultimately more too, because ultimately what they're saying is that inflation is too high and it's persistent. Therefore, we need to cause a recession, cause people to lose their jobs so they can afford even less of the gas.
I mean, that doesn't make any sense. What's the
That's
benefit?
what they're doing.
Like, what's the benefit of it, though? Or what's their perceived benefit? I should say.
Their perceived benefit is they're trying to tamp down demand.
Okay.
And they're trying to tamp down demand by and large by making people have less money. Now that, people who rely on their portfolios are probably thinking about their budgets more seriously these days. And if you are considering, hiring, the number of job openings has begun to decline and the number of unemployment claims has begun to rise. And so, oddly, Powell made a comment. Jerome Powell is the Fed chairman, who made a comment that he basically wants to reduce the number of jobs out there to tamp down inflation. So it is a comedy of errors, and that's not a political. I mean, it's just they made an error on the way up, and they're causing another error on the way down by tightening monetary policy into a recession, which has never happened before. So, it's gonna be interesting.
So what can we do? What can I do? What can a listener do who is like, okay, so this is good. Like something to look forward to here. Inflation and recession and
my opinion is you play defense.
Okay, so how do we play defense?
I don't know that there's a great way for me to answer that question on a non-individual basis. I mean, you would.
Well,
you would reduce your number.
Yeah, what if you're starting from scratch, right? So you have, let's say you're not one of the people who are going to have their jobs eliminated, right? You have an income, you can pay your bills, you see the writing on the wall. So maybe you could pay your bills, and you have a little bit extra to invest.
Yeah.
Or so you can contribute to your retirement, right? So how do you? And you're thinking, okay, like I'm getting started now. I'm 25 years old. I want to start my portfolio now. What's the mindset I should have as I begin my journey of starting to build something that's going to last?
Well, if you are able to continue to allocate a portion of your earnings to your portfolio, then this will be great. Because you're going to get a lot of units for those dollars that you're putting in there. The riskier thing is, what if you are nearing retirement or just started retirement or in retirement and you're relying on your portfolio while the Fed is actively trying to crush you? That is the much scarier position to be in. And I get it.
Is there anything you could do at that point, though? Like, I mean, you could, because you don't want to liquidate everything, right? And you don't want to. It's not like like having cash is going to be helpful anyway.
That's why it's hard to answer. It just depends. I mean, the answer would be, you want to make sure you have enough money set aside in your portfolio and conservative stuff to make it through the next at least 5 years.
Okay,
that's what I would say. That's a starting point, but that's always true. If you're in a distribution portfolio or you're going to be retiring in the next couple of years, you want to make sure you've thought that through. And then it's what do you invest in that's going to get that's going to benefit from this regime change? And we already talked about it. It's commodities, things, real assets, things that did well in prior inflationary decades, in my opinion, are far likely to do better, far much more far likelier to do better than the things that did well over the past 10 years. So if you go back to like the 1970s as a good, you know, was it Mark Twain said, history doesn't repeat, but it sure rhymes.
Yeah.
Right? So, this is probably not going to repeat exactly, but gold did the best. Oil did the second best. Real estate did the next best. And then I think farmland did the next best. And then everything else was flat or negative. Bond stocks, all that kind of stuff. So, what I'm doing is encouraging, and with my client portfolios, is I'm not investing, just assuming that everything is going to bounce back and just go back to the way that it was. And that has been, so far, a wonderful call.
Yeah, you talked about energy.
Yeah.
As well.
So that's another reason why inflation is going to stick around. It's because we have, as a collective West, underinvested in energy, particularly in fossil fuels, for a variety of reasons, many of which are totally legitimate. But essentially, we have tried to replace fossil fuels before we had a sufficient alternative.
Like solar, like wind, like nuclear.
Well, nuclear would be wonderful. Nuclear is, in my opinion, the solution. But the problem is that it takes years to build a nuclear plant. And it'd be a wonder if it could even get done in the United States these days. And the problem is that the fossil fuel industry, whether it's oil, natural gas, or coal, has had an 8-year period of underinvestment, where the amount of capital dedicated to sourcing new supplies has been historically the lowest. It is, if you look at a chart of capital expenditures by the oil industry, for example, it's never been lower as a percentage of their earnings or percentage of their revenues, and that's been a trend for a variety of reasons. The first probably being that oil prices were low, and so there was no reason to invest in it if energy prices are low. Another reason is ESG concerns, environmental, social, governmental, or governance concerns. And so lots of large money managers that control these gigantic passive investment vehicles like Vanguard and BlackRock are actively discouraging energy inclusion, including energy investments in their funds. There are many pension funds. CalPERS, the California Pension Fund, has committed to selling all of their energy, fossil fuel companies, and so basically it made it impossible for the companies that pull the oil or the gas out of the ground to fund new investment. But every oil well, every gas field has a natural depletion ratio. And so they all go to zero at some rate. And so the amount of capital investment required just to keep global production of oil and gas flat has not even been happening. And so we are at a point now where we are at the early innings of an energy crisis on a global basis that is going to, one, have a severe inflationary effects. Energy and fossil fuels in particular go into everything. If we were to look around your office right now, it would be hard to find something that didn't have a fossil fuel component in it.
Yeah.
To the shirt you're wearing, the watch on your wrist, the desk that your elbow's on, the carpet, the lights, the computer, everything. And so it is one of the most fundamental inputs to a developed modern economy. And so when the price of that input goes up, the price of everything goes up. Now, this is also coinciding with a period where a majority of the world's population in emerging markets like India and China are coming into the middle class, where the energy consumption for middle class families goes up dramatically. And so their hunger, their appetite in China and India, for example, the two biggest examples in world history, their energy needs are going up dramatically. And so the demand for energy is going up. And we have a supply problem with fossil fuels because we have been punishing that. And it's a political football too. And the very first act that Joe Biden did, or the very first executive order that he signed, was canceling the Keystone XL pipeline.
Mm-hmm.
Now, you may think that was a good idea or not, but it definitely exacerbates this problem. And then also, if you pay attention to the physics of energy, there's a metric, EROIE, energy return on energy invested. And the civilization has advanced when you have had a greater energy return on energy invested. So if you go back to 17th century or before, the biggest cities in the world, Tokyo or London, or tended to max out their populations around 1 million people, and the forests around those cities for many, many miles were obliterated, and that was because they used wood.
Yeah, for fire, right? For energy.
For heat. Yeah, for energy. And so then coal. They basically said, well, we're out of wood, so now we got to use coal. Fortunately, coal had a higher energy density. And so then it created pollution, but so did burning wood. But then cities got bigger because you had a more dense source of energy. And then you went from coal to oil, which was even yet a more dense form of energy. The problem with solar panels and windmills is that their energy density is poorer than wood. And so they are not substitutes.
Right. But in a way, they're more renewable. So,
not really though, because battery technology, batteries require mining of lithium. Of nickel, and then they have a shelf life, and then they're too expensive to recycle economically, so they're put in a landfill. The amount of steel and copper that goes into making a windmill is gargantuan. And so and then have you ever seen what they do with them when they're done?
No, what do they do?
They put them in the dirt. Yeah, they just create a massive landfill. That's why I said earlier that the best solution from a physics and environmental standpoint is nuclear.
Yeah, but isn't there waste from that too? And I know that they've talked about there's a lot more ability to safely manage the waste.
All of the waste, as I remember this correctly, all of the waste from the nuclear power plants, all of the waste that has ever been created by the nuclear power plants in the United States of America could fit on one football field.
Yeah, it's crazy to think about, but I guess it's what's interesting is that when you first brought up the energy, I was thinking, okay, well, cars. The future of cars is likely going to go electric.
Disagree.
Okay, so we can disagree on that, and that's fine too. But the interesting part about that conversation, I think, is more so that it's not like, okay, cars are all electric, like we don't need gas and oil anymore. Like, no. Everything in your house there's going to take some amount of oil.
Unless it's powered by a nuclear power plant, then it's probably powered by fossil fuels. But it's a far less efficient way to do it, because say you even have a natural gas power plant, then you get the power initiated at the power plant, and then it has to run over the lines to your garage where it loses 50%. So is that even more efficient than an efficient Honda, internal combustion engine Honda Civic? No.
Right. Emissions wise, I'm curious, and I don't know if you even know the answer to this, but I thought about this was, okay, well, if everyone in the United States, just for an example, had an electric car and they charged it at their house.
Yeah.
It's not like that energy is coming from somewhere. It's not free energy. It's like, it's that whole phrase, like there's no free lunch. Like, we are creating energy to put in that car. It's just not oil. It's coming from the power plant.
And New York State shut down Indian Point nuclear power plant I think it was last year or the year before, and that energy was the most environmentally friendly energy that there is out there, and that the deficit that created has been filled by natural gas and coal. So our CO2 emissions have gone up
In New York.
because of, uh, in my opinion, faulty environmental thinking.
Man.
So to bring this full circle, inflation is sticking around even after the port congestion gets figured out, even after this monetary reset happens, even after China reopens and they're back to full production. We're still going to have an inflation problem because the most fundamental part of modern society is energy. And if you don't want energy, then you can go look at areas of the world that don't have any, and that's how you're going to live. So there's a, not to get too abstract. Have you ever heard of a fourth turning?
No, I haven't.
So I have the book at home. I haven't read it yet. I've listened to the audiobook some years ago, but I'm going to reread it because it keeps getting brought up in things that I'm reading, which is that every 4 generations there is a turning, which the last turning was essentially the Great Depression into World War II, where every 4 generations there's basically a change in the societal structure through some cataclysm, and the old is thrown out and the new generation comes in. And a lot of the things that we're going through, beginning with COVID, the energy crisis that we're having, the war in Europe with Ukraine and Russia, it's all very fourth turning esque. So in your free time, look that up because it's.
I will. I mean, what do you think the future, in your opinion, I guess we'll stick to finance with it, not even like geopolitical, but what do you see in the next 10 years in terms of just the financial future and we'll even keep it United States. I mean, where do you think we're going with this?
We are going to have, we have no choice but to have an inflationary decade. And the reason is because there's too much debt. And the 1970s inflation essentially ended when Paul Volcker raised interest rates to astronomical levels, caused a recession, and as the story goes, that nipped inflation in the bud. The thing that's different today as opposed to the 1970s was the debt to GDP ratio in the 1970s was 30%, and today it's 130%. So the national debt on the U.S. is something like $30 trillion. So every 1% increase in interest rates costs the federal government $300 billion. So if inflation is running along at 8.5%, you cannot raise interest rates above the rate of inflation, which is essentially what it would take to kill the inflation, because you would bankrupt the federal government. The federal government is already running what is known as a primary deficit, which if you add up entitlement spending, interest payments on the debt, and defense, you're already in the red. Tax revenues don't cover that alone. So then you have the discretionary stuff on top of that. So we are already in a situation where we are taking on new debt just to service old debt, and higher interest rates exacerbates a funding crisis, a sovereign funding crisis that is not unique to the United States. I mean, Japan, China, Europe, they've got all these problems too. So you cannot raise interest rates enough to defeat inflation without causing an even bigger problem with government sovereign debt markets. And so therefore, it, in my opinion, is better to think of inflation as a feature rather than a bug. And that's how I'm investing my portfolios, and will be investing my portfolios over the next, I don't know, 5 to 10 years. So we've been in this situation before too. So at the end of World War II, the debt to GDP ratio reached 119%, and what the Federal Reserve did then was essentially artificially hold down the rate of interest on government bonds. And so if inflation is clipping along at, let's just say, 10%, and the interest rate on government bonds is at 5%, essentially you are going to inflate away your debt. So your economy is going to grow at 10%, but you're holding down the cost of your debt at 5%. So your economy is going to outgrow your debt. And your debt that, for the people, the creditors, that's terrible because they're going to get paid back in dollars that are worth a lot less than the ones that they lent. But that's called financial repression. And other than an outright default on Social Security, Medicare, or government bonds, it's the only option. So right now we are in a situation where the Federal Reserve is essentially trying to tamp down inflation with mild monetary tightening, with raising short-term interest rates, and they have at least stopped buying new government bonds or funding new government debt. And already the stock market is down 20-25%. And the bond market is down 10 to 15%. With the amount of debt that we have out there, something is probably going to break real quick. And that's why I mentioned this is a good time to be defensive. And for what I'm thinking of over the next 5 to 10 years, it's sort of this weird position to be in, because I don't remember being this excited about my portfolio future returns, because if the scenario plays out along the lines that I'm thinking of, then things like commodities and gold are going to go to the moon.
Yeah, I think we're definitely in an interesting time, and like you said, it's not completely unprecedented, but I think we can learn from the past. I am curious.
You tell the politicians that.
Yeah, right. So you're a father.
Yeah.
How important is it for you, someone who has made a career in finance and understanding economy, how important is it for you to instill money mindset or investing or just the understanding, the value of goods, of service, of money to your daughter?
It will become more important. I mean, she's 6,
Yeah.
so I'm not trying to, get her to pay for things out of her, allowance, or, we try to, point out that things are too expensive, and so when she'll ask if a toy is too expensive when we're at Target or something like that. So I don't know. You're a dad too. I'd be curious, when do you really want to start getting more intentional with those kinds of things? Because I would say up till now, we've been sort of de minimis on it. For me, growing up, we were poor, so there was just never money for anything. If I wanted, clothes, then they had to come from my job. So I've worked since I was 14. So it's a good question that I probably should spend more time thinking about. So you tell me what you think, because I'm curious.
Well, I think it's hard because on one hand, like you said, when you grow up wanting and without, I think that you can end up in a situation where you become an extreme spender when you do have money. Mm-hmm. On the other hand, there's multiple examples of people who grew up getting everything they want. And I don't know if it's a lack of education. I don't know if it's just an entitlement. But they're often people who end up like way, way in debt when they don't have the same money their parents were bringing in, early on. And I think it's a balance. I think that it's something that Lisa and I tend to at least discuss with specifically my older son, right? At 10 years old, he's kind of understanding, like, I want to buy this, I want to buy this. And it's like, okay, we don't want to tell him that he can't afford certain things because he does have some money from chores, from doing whatever, but we want him to understand the value of his dollar and what it can get him. So I'll just give you an example. Like, a lot of times he says, like, he plays baseball right now, and he's been, a lot of the kids at the baseball field have these expensive baseball bats.
Okay.
And I'll say, okay, that bat, if we go to Dick's, costs $350.
No way.
Yeah, it's crazy,
Really?
first of all. And I'm like, what are you going to get for that $350? Are you going to hit the ball 100 feet further? Are you going to hit the ball, if you get up 10 times and right now you hit it 5, are you going to hit the ball 7 times, right? What's that value of that? Like, is that $350 bat going to be that much better than the $100 bat
Great
you were able
question.
to buy at Dick's?
Or is it a social thing where
Or are you just trying to look cool in front of your friends?
Right.
And and ultimately I think it's just having the conversation is good. And then we always default to, you're not getting the $350 bat because it's a $350 bat.
Right.
But I think it's just kind of like making them aware. I mean, I don't know. We talked about doing, like, over the summer, like, doing an investing, like a mock investing thing where we bought different stocks and just looked at what they did over time. And I know that you could do that with, like, TD Ameritrade.
Yeah, it's fun. And that's a great way to teach people about, delayed gratification too.
Yeah.
And ultimately that's what it's about, right? It's, I could do this now or I could do it later. And if you are willing to do it later, then ultimately your later is going to be pretty good if you make that decision over and over and over and over again. So how do you teach, in my mind, as I'm thinking through this just on the fly, is delayed gratification. And so if you could, and I probably should be better about it too, tell, Phoebe's my daughter's name, that if you do this chore now, then we'll reward you with something that, gratifying later on. Or you could have, maybe there's some games you could play, like you could have one lollipop today, but if you wait until tomorrow, you could have 2, and if you wait till the weekend, you could have 5. I don't know. It's all sort of, in my mind, along that delayed gratification. And you had mentioned, people who grow up poor being big spenders, or people who grow up when money is never a problem, not caring about having money problems. I never was able in my own life, through my own anecdotes, able to suss out any coherent, consistent dynamic like that. So, I grew up, when we had bouts of very real poverty, and and that was formative for me. That was I hated it. So all I knew was to get good grades, and it's worked out wonderfully for me. But I have some cousins who did not have experienced the poverty that I had, and I would say even were upper middle class, or if not more. And they're wonderful people. They're some of my favorite people. I love them, and they make good choices. So those are just 2 anecdotes, but I don't know. I think I don't know if it's, as a parent of somebody who comes to it with my background, I've had a mission to ensure that my kids don't have to go through what I went through. But that is a catch-22, because going through what I went through also made me who I am today. And so if you were to ask me would I do it any differently, the answer would be no. However, I'm still not going to do that to my kid, right? Yeah. So, you have to hope that you can teach them that how to be a good person without having them go through some of the real trials. And I look all around, I can see that that's true. So,
yeah. Well, Brennan, I think that's an awesome spot to to pause this until next time.
Cool.
I think we have gone through a lot in terms of, expectations, where we are now, how we can have a smart mindset going into the future.
I apologize for scaring your audience.
No, not at all. I think, you say scare, but it's reality in a lot of ways, right? And well, some people may be optimistic, others are pessimistic, and I think it's just the reality of the situation we're in. No one can predict the future, but people can prepare for it, and I think that's key. So if someone is listening to this, and this is going to be a Rochester, New York podcast, however, if someone is looking for some financial advice, you're here in Rochester, man. How can people get a hold of you and maybe have you manage their portfolio?
Go to sagerutty.com, and that's where I hold my practice, and there are a variety of other practices there. So even if I can't help you, I'm sure we can find somebody that can.
Nice, man. And that link will be in the show notes. So I do like to ask 3 questions at the end of every podcast. Yes, yeah. I know you've listened, so you know what they are, hopefully. But the first question is, what is the most impactful book that you've ever read?
How to Win Friends and Influence People by
Carnegie?
Dale Carnegie. I was an introverted, unconfident, shy wallflower, and I always was envious of people who could walk into a room and fast make friends and have a sort of charisma. And I went from being very poor at it to being quite good at it by learning the tools in that book, which opened so many doors for me.
That's awesome. Second question is, if you could have a drink with anyone in the world, past or present, who would it be? What would you drink and why?
Abraham Lincoln, to say thank you.
Just thank you? Yeah. Nothing else? You wouldn't ask him anything?
Neither one of us drink alcohol too, so it would have to be some apple juice or something. I don't know.
Oh, man. It's Abe Lincoln would be interesting for a lot of reasons.
Right. You redeemed and affirmed the experiment through which I have benefited so greatly.
Yes. We actually, it's interesting you say Abe Lincoln. We watched, when I say we, my family, my wife and kids and I watched Remember the Titans yesterday. And it was eye-opening. I love that movie. I think it's one of the best movies ever made, personally.
Okay.
Have you seen it?
No.
Okay.
It's a football movie, right?
It is. It's a football movie, and Denzel Washington is a football coach from,
okay.
I want to say it's
Love Denzel Washington.
1971 it's placed in.
Okay.
And it's in what was the segregated South of Virginia, in an all-white school that became segregated in the first year. The head football coach that was there was a white guy who was supposed to be, a Hall of Fame coach. He was going to be inducted into the high school Hall of Fame for Virginia that year. And they ended up taking his job and giving it to this black coach as they integrated the school. The school board did this.
Is that Denzel's character?
And that's Denzel's character. And there's a lot of hatred and argument at the time about why this was happening and how they could do this to such a prominent coach and such a prominent school. And ultimately, it's a beautiful story about how black and white could come together as a family in a time on this football team and be accepting of each other, even when everything was chaos around them, specifically in the integration of the school itself. It's a beautiful story, but what happened was it opened up these conversations with my kids about why were they treating these black kids this way? Why did they call this coach a monkey? Why, and it was in a way, it was so inspiring to know where we are now compared to where we were then. And we're only talking 40, 50 years ago, which is the amazing thing.
Right, which was a gigantic improvement over the 50 years before that, over the 50 years before that.
Exactly.
So the question that I think of is, what are we doing now? That in 50 years, we're going to be like, what idiots we were.
I know. There's probably so much, right?
That takes extreme genius to see. So I don't think I have it, so.
Yeah, well, I think, my takeaway from it is just, be kind and accepting to everybody, regardless, and fly your own flag, but just know that I'm gonna love you no matter what, and I'm just gonna be supportive of everybody that I can, and try not to at least instill my morals on their decisions. But who knows?
Your kids have a good dad.
Well, thank you. I appreciate that. Last question. So the Every Breath Counts podcast, it has a twofold meaning. On one hand, you have a finite amount of breaths in your life, and you need to use those breaths to do what you can to accomplish the greatness that's within you, and accomplish anything you can. And on the other hand, you have a finite amount of breaths in your life, and you need to use those breaths to be grateful for each and every breath you have. So how do you make every breath count in your life?
I pursue an intentional attitude of gratitude in everything that I do, and that's how I start my day, with a prayer of gratitude. And whenever you hear a bad story, in the news or something like that, I always think how grateful I am that didn't happen to me.
Yeah.
And I've also been confronted with this more recently, because my practice has been getting busier, and so I've basically had to become more selective about taking on clients. And I'm telling my colleagues at work that my number one priority is being a dad, and this is all great, but my heart is there. So this is so I've done a good job, especially over the past 3 years, of maintaining perspective about what's really important and about what I'm really trying to achieve with these breaths that I'm blessed with having. And it's just the foundation of it is gratitude.
Well, Brennan, dude, this has been a blast. I want to thank you and commend you, because, we've been neighbors now for going on 5 years.
Yeah.
And you've been there for a lot that I've been through. I can recall, a lot of great nights out, hanging out. And one in particular, I was going through a hard time. It was my dad just passed away.
Yeah.
And I text you, and I was like, hey man, I'm just sitting out by the fire. I don't know what you're up to. And you came over, and we just sat together for, I don't know, 2 or 3 hours.
Couple hours, yeah.
Yeah. And we just talked. And that's the kind of guy you are, and I know that you care about people, and I know that you're kind and compassionate, and you're a good dad, and I respect that. So thank you for being a friend to me, for coming on the podcast and just sharing, your wealth of knowledge about finance, about fatherhood, and I appreciate it, man. So thank you.
Thanks for having me on. It's been exciting for me, and I'll say all that stuff right back. And one thing I would say before we hang up is that I look for role models all over the place, and one of the things that I look to you for is how good of a dad you are, and how much time and commitment you spend with your boys, and how that is your focus. And I watch, and I'm impressed, and you're a role model for that for me. So thank you, right back at you.
Well, thank you so much, guys. If you are looking for a financial planner and you fit the criteria to be a client of Brennan's, I couldn't suggest him more. He'll listen to you. He's a great guy with a really, really good head on his shoulders, and a really great understanding about the situation we're in, and how to manage it financially. And if not, hey, just take this advice and impart it into your own portfolio, and hopefully, you can make some smart decisions. But be aware of the situation we're in. Be aware of the situation that you personally are in. Do the best you can. Be the role model for your kids, for your friends, and make every breath count.